Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
2 years ago, he was my economist of the year. He had an optimism about the American economy amidst recession. Gloom, Neil Dutta takes a continued victory lap. He's with Renaissance Macro this morning. Stop by the Fed show. He was so wound up about the Fed meeting.
Was he? Okay.
He called my people and said, I demand to come on.
Okay.
Joining us now because he demanded to come on, Neil Dutta. Neil, let's go back to the last Fed meeting. Why did you go mental? Why did you say, I got to come on, the Fed decides?
Well, thanks for having me on, Tom. Happy New Year. Well, I would just say that it was a complete 180 from the meeting right before that, when they said they wouldn't prejudge policy outcomes right after the election. And what did they do in December? They prejudged policy outcomes before anything even happened, basically taking out insurance on potential tariffs before Trump even takes the oath of office. I thought that was quite revealing. So this idea that the Fed is responding to the data and adjusting their forecasts, I don't really think that washes. If you look at how much the data surprised on the upside with respect to March, I mean, it would make more sense to push off rate cuts at that meeting. But in December, erasing 2 cuts, given the forecast revisions, I thought was a little bit much. So this was really about a balance of risks story that they explicitly said they wouldn't do.
The higher yields and the attendant strong dollar, does that force or cause a slowdown?
I think so. I mean, when you look at the nature of why interest rates have been going up, it has very little to do with the re-rating of nominal growth expectations. I mean, if you look at the data, your own Bloomberg Surprise Index has been weakening in recent weeks. So the economic data has been slowing. If you look at inflation expectations, both of surveys of consumers and businesses, they've been falling. So, my sense is that this has something to do that's not related to the data. I think it has to do with term premiums. Maybe that's a function of QT. Maybe that's a function of what's going on globally. You're seeing rates go up in Japan, for example. Maybe there's risk around deficits, and so there's going to be more treasury issuance relative to the demand for treasuries. I mean, these are all things that push up the term premium, but it doesn't really have to do with growth expectations. And if the term premium is going up, that's a tightening of financial conditions, right? I mean, the declining term premium was a big driver of sort of risk appetite, stronger equity price. In recent decades, frankly. And, to the extent that's going away, that's going to be a headwind for stocks.
Neil, I'm an equity guy. All I know about the bond market is bond prices go up, yields go down.
Nailed it.
That's about it. But I got my Federal Reserve cutting interest rates. Why are my yields in this bond market thing going up? I thought the yields should be going down.
Yeah, I mean, it's a good question. I think, obviously some rates are coming down. Some private sector borrowing rates have been coming down alongside the Fed easing. So, for example, HELOC rates have been coming down. Auto loan rates have been coming down. Prime rates obviously have been coming down because those are very much keyed off what the Fed is doing. But, things like mortgage rates, those have been high, elevated. And and as I mentioned, I mean, that's, to some extent, it's out of the Fed's control. I mean, I think one reason why they're going up is because, at some level, the economy has been doing a little bit better, at least initially after the September meeting, somewhat better than expected. But I don't think that goes far enough to explain why interest rates have backed up. So I think that's part of the reason, but it's not really the bulk of the reason.
What's the Fed focusing on here, Neil, do you think? Is it the absolute inflation number? Is it the labor market? What is the Fed focusing on these days, do you think?
Well, I mean, I think to the extent that the September meeting was a focus on the labor market, I think the December one kind of put inflation back in the driver's seat. I mean, they're clearly, all you have to do is go through the document that they release with the summary of economic projections and go to the balance of risks, right? You have a overwhelming majority of participants on the FOMC seeing that the balance of risk to core inflation are skewed to the upside. It completely flipped from where they were in September. So I think the realized inflation data has taken on a lot more importance than it did, maybe 3 months ago.
And Neil Dutta with the Renaissance Macro, he'll be with us through the entire half hour. I do want to point out that he works with Jeffrey DeGraff, who had a better than good 2024. Okay. We were hoping to get Mr. Mr. DeGraff is very tough to book.
Yeah, he's a tough
He's got,
guy.
it's not like Dutta. We can get Dutta anytime we want.
Okay.
Jeff DeGraff is just like absolutely impossible to get. What do you learn from Jeff DeGraff right now, Neil Dutta, when you tie in his world-class equity coverage into your call of a slowing economy? How do you synthesize those two?
Well, I mean, I would say that the market is oversold. So that's reasonably good setup going in into the new year. So you're sort of probably due for a bounce. But I do think interest rates up at these levels concern him. That's something to keep in mind. For my own part, I mean, I would say that really, to me, the big story, frankly, is the performance of housing, right? I mean, this is why, you mentioned Economist of the Year back in 2023.
It was a weak moment.
I didn't get that back. I didn't get it for 2024, Tom, unfortunately. I would just say that one of the reasons why I made the calls I made in 2023 is because at the end, 2 years ago, at the end of 2022, the Fed was dialing back kind of the hikes, and housing stocks were outperforming. So that's kind of an interesting tell. Now you have the Fed cutting, and housing stocks are underperforming. So I think the underperformance of home building is, I think, an important kind of.
Neil, I got a fiery response out on YouTube on the housing market. What is your insight of where the housing market goes for 2025?
Well, I think it's not going to look particularly good as we go into the spring selling season because mortgage rates are running close to 7%. I mean, with the labor markets cooling, the math doesn't work for a lot of people. And I think that's the primary issue right now with respect to housing. I mean, if you look at home building, builders, new housing, if you look at single-family homes for sale that have been completed, that number is up over 50% against last year. So there's slack building in the new housing market. I think Paul mentioned sort of the increasing inventory situation in parts of the South and the West. I mean, remember, that's like the meat of the market, right? So if inventories are going up in those places, that means that construction is going to be coming down. Because that's where most of the construction happens, frankly, right?
This is important. Neil,
construction employment is at risk now.
I want to go to Neil Dutta and Paul Sweeney. Lisa, jump in on this. This is important. Isn't where we live an aberration, Paul Sweeney? Like where we live isn't normal.
No, because I think the density we have here in the metro New York area is so crazy and Lisa's looking for a new crib.
Are you looking for 6,000 square feet?
No.
That's the backyard.
But it's like getting outbid by these offers. That is crazy.
Yes,
like a house goes on the market for $600,000 in New Jersey, and it sells for $740,000.
It's amazing.
And it's like, how do you?
Yeah, but that's not the rest of the world here. So hey, Neil, so let's step back. We got the labor market, the real estate market. How's the consumer doing out there? How do you think about the consumer here in 2025?
I mean, I think it's going to be tough to sustain the kind of consumption pace we saw last year, right? I mean, if the labor markets are slowing and wage growth is cooling, which I think is clearly happening because, things like hiring rates are down, quits rates are down, there's not really much need for firms to be paying up and bidding up the wages of their workers. So with the slack in the labor market, that's, slowly building. I mean, the labor market's not collapsing, but it's hard to be bullish on the consumer given that environment. And I also think there's probably a bit of an asymmetry, right? I mean, the thing that's been supporting, I think, consumption has been, rising wealth, equity prices going up, home prices going up. And to the extent that doesn't continue, I mean, we've seen some slowing in stocks. I mean, there's probably an asymmetry there, right? Where a modest slowing gets you maybe an outsized slowdown
right? So that K-shaped economy
It's
here.
the second time you've mentioned it.
I like it. It makes so much
Is it about
sense to me.
Tom Keene?
Yeah, exactly. That K-shaped economy I kind of makes sense to me. So what should the Fed do given that here? I mean, again, I guess if you look at the WIRP function, WIRP go on the Bloomberg terminal, this suggests maybe a couple of rate cuts this year. Should the Fed do more, do you think?
I mean, I think they will do more because I think the data is going to slow and inflation. I mean, to me, the most notable thing that's happened, frankly, is the slowing in rental inflation, housing rental inflation. That's been really the main shortfall relative to the Fed's longer run inflation objectives, and now that appears to be working, right? I mean, in the favor of disinflation. So I think that's important. Obviously, we're all watching what's going on with the dollar, but that's going to weigh on the prices for imported consumer goods, I think. So, no, I think the Fed's going to be ending up, if I had to pick, I'd say that they're going to cut more than twice. So I think that the front end of the yield curve is a pretty good place to park your money at the moment.
Neil Dutta, I wanted to go there in the dollar. Kitchuk's joining us in about 2 hours, folks, with SocGen in Europe. Just brilliant. But let's talk to foreign exchange trader Neil Dutta here as well. Are the dollar movements, Neil Dutta, nonlinear or linear? Like DXY 107, 108, 109, or is there a Neil Dutta tip point where things begin to unravel?
I mean, I think there's probably something to the idea that at a certain point, like more things start breaking. But when you have like 1% currency moves, that's a big deal, right? I mean, so I think the dollar's concerning across multiple dimensions. I mean, number one, obviously it weighs on U.S. exporters, particularly manufacturing. That's number one. Number two, going back to the equity market discussion, it weighs on earnings, right? Particularly for tech companies that are global in nature. And because that's been a big driver of U.S. stock prices, I think the fact that the dollar's been strengthening is going to weigh on earnings and, by extension, weigh on stocks. And I think it matters for the rest of the world, obviously, particularly emerging markets, because they have lots of dollar-denominated debt. So the cost of financing that debt goes up. And then you have to start worrying about balance of payment problems in EM, which obviously if they're slowing, that creates a negative feedback loop, pushing the dollar up even more. So, I think, because of safe haven consideration. So, yeah, I think it's concerning. But again, that's not really a world where the Fed can just kind of sit back in its chair and say, oh, we're going to cut twice this year.
Right.
So, to me, the dollar represents an unambiguous tightening of financial market conditions.
Neil Dutta, thank you so much. Hugely valuable, generous time here on a Friday morning to start the year off.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
A bond person comes in. Paul, you nailed it earlier. What did you say, price?
Up. Yields down.
Nailed it. Okay, there we go. We're not going to do that. Joining us now, Priya Misra, with a Friday Get the Year Started discussion. And everybody's sitting in their kitchen this weekend discussing how much they've lost betting on football and also their portfolio. You and I are going to talk Jensen, Trainer, Sharp right now. Adults in the business say, how much did I make, but how much risk did I make making what I made? And William Sharp out at Stanford identified this. Explain to mere mortals worldwide what the Sharp ratio is and why it matters.
I love that you're talking about Sharp ratio.
It's great. You and I can bring a bar conversation
You guys
to
might
zero.
be the only two people here.
I love it.
Explain why they're sitting at their table this weekend and they're like, why are we not making money? Sharp ratio, go.
So there's a lot of, well, I should start with Happy New Year. Thank you for having
It's not
me.
happy. I have children. Continue.
The focus typically is on the return. It's what return am I getting? You're getting that return taking risk. And, you're talking about have we not made enough money? I think bond people who thought the Fed's starting to cut rates, and that was where we were a year ago, the Fed's going to cut rates, they typically cut 200, 300 basis points, you're going to make a lot of money in bonds. I don't think, that's where they lost money. They put money in stocks, they did well. We're in a soft landing. Pretty much every risk asset did well. Credit did great. Now you take stock and look at the uncertainty. You have the Fed with an army of PhDs saying we have a lot of uncertainty. We don't know how to manage the cyclical and the structural, so we're pausing. And so that's where that sharp comes in. Let's look at the risk and return. So let's look at the return relative to the risk, which is what you alluded to, Sharpe ratio. That's where I think fixed income, you're getting 6-7% in high quality fixed income with not a lot of risk, because I don't think exactly. Yeah. And so that your denominator, if it's lower, suddenly fixed income makes a lot of sense.
On one more wonk question, folks, and Sweeney's going to bring us back to normal. You have a superior Sharpe ratio on the JP Morgan core bond versus your peers and versus the index. That's a 1-year Sharpe ratio. There's a 3-year look back. There's a 5-year look back. I'm wedded to the 3-year Sharpe ratio. Folks, of whatever 401k plan you've got, which duration is the most value to Priya Misra?
So I would say
besides the one that Bob Michael wants.
I would say that we look at 5-year, 10-year. Consistency is such a big part of, it's our DNA. So just making sure that we can consistently outperform. And how do you do this? You diversify a lot so that the risks are you're not wedded to one particular risk, and you do your research. In a high cost of capital world, dispersion is going to be high, meaning some sectors will do well and others will not. And I wish I could say we know exactly which sectors are going to do well. If you diversify well and you do that research, that's where you get that superior Sharpe ratio.
Bill Sharpe, 90 years old, out at Stanford.
Oh, is that right?
Yes.
Wow, I didn't know.
Continue,
Okay, very
Paul.
good.
Bring us back to some sense of normal, Paul.
2024, fixed income investors got paid to take some risk. High yield leverage loans, by far the best performers. Is that going to spill over into 2025, do you think?
I think so. And here's why. Let's look at fundamentals. Fundamentals of the corporate sector is still very strong. It was strong a year ago. It's still strong. You're looking at strong balance sheets, strong business models, earnings are decent. We're also looking at what are companies doing with their debt. Are they re-levering up? That would make me a little nervous. Mostly they're not. I will say since you talk about high yield and leverage, high yield default rates, including the restructuring, has been 1.5%. It's low. Leverage loans a little higher. So I think you have to be careful what you buy. We like high quality high yield. We like parts of leverage loans. I think fundamentals are strong. Then let's look at technicals. Technicals extremely strong. People are looking at the returns they had in equities and they're saying maybe we should rebalance. You look at fixed income, if you're getting, in high yield, you're getting 7-8% with lower volatility. That's why we're seeing continued inflows into bond funds. So I would say technical, fundamental, very positive for fixed income. I think you have another good year as long as that soft landing is maintained.
Are there some industries, sectors that are attractive to you that screen well for you guys in terms of maybe taking some credit risk?
So I would say financials is an area that we like. Utilities is another one in investment grade. Within high yield, there's parts of media and telecom that have been beaten up. And they've actually started to perform well. And that's where, but I would say rather than sectors, even look at companies. You have to drill down into balance sheets to make sure you know what you own, particularly as you sort of go down that risk spectrum.
New issuance. We've seen a ton of new issuance in the bond market. Did they call you up when Morgan Stanley and Goldman Sachs, they've got new issuance? Did they call JP Morgan Asset Management to buy new issues? Are you guys known as, hey, we'll buy pretty much anything you got for sale? How do you guys do that?
Not everything that's for sale. We absolutely look at the new issue market. Sometimes there's a new issue premium, as there was. We started to see the new issue market sort of begin yesterday. We would love to buy something with a premium because you're getting paid to buy that new bond, which is actually going to be more liquid, and you can get out of some of your older bonds. We're getting inflow, so we're investing. I think January tends to be seasonally a higher issuance month. So we expect more issuance. What I'm looking at is net issuance. So 5 years ago, when COVID hit, or 5 years ago, you have this big burst of issuance.
Yep.
And what we're seeing now is that issuance is being refinanced. If net issuance was picking up a lot, that means the corporate sector is getting levered up, I might hesitate to buy. This is still net issuance, we think will be actually lower this year compared to last year. Gross issuance will be high, but companies have to refinance, investors have to refinance.
So Tim Cook watches the new episode of Silo tonight on Apple TV, goes mental over the dystopian destruction of the world, and he goes out and issues $30 billion of bonds. Do you want to buy Mag 7 paper?
I like the fundamentals of the Mag 7. What I don't love are the spreads. I mean, you're
not getting paid.
They're tight. You're not getting paid. I would rather look at you can take the same risk if you take it in securitized form. That requires even more work.
What does that mean?
So securitized would be...
You own John Tucker's new iPhone? Is that what that is?
That would be a tranched up, structured security with more consumer risk. I mean, there are some corporates in housing, single-family rental. They take all these loans, they put it in a structure and tranche it.
But Apple's not doing a securitized. They don't have to.
So I would say I'd like to take that credit risk, but where am I getting paid more than the 70, 80 basis points you're getting paid? So it's more about what return am I getting versus the risk I'm taking. And that's where I would say securitized will screen better than something like Mag 7, though the fundamentals are strong.
Are you getting cash inflows into your bond funds these days? What are your clients doing with allocation? Are they putting money into the bond funds?
We are getting inflows. I think the industry is getting, I'd like to say, are we getting more market share? I don't know. The industry is getting more inflows. We're absolutely getting inflows. I think people are looking at all-in yields and looking at their portfolios and saying, well, maybe we should put some in fixed income. The other thing they're looking at is cash is giving you 4%. And a bond fund is giving you 5-6%. Okay, I'm picking up yield, and so I'm moving up.
I got 25 seconds because we've got to move you out because Barr's got to sit down. It's in his contract for 2025. Are you picking out carpet yet for the new skyscraper? Are they having the designers in saying, Priya, do you want it in maroon?
Yep.
We are very excited about that building. We can see it go up in front of us.
Have you been inside?
We haven't, but it does look like it's getting there in 7-8 months. We're told it'll be done, I hope.
It's like Silo. You look out the windows of the cafeteria at Park Avenue, and you're not sure what you're looking at out there.
No, we're doing a remote. I'm telling Jamie Dimon right now, when that thing opens, we're doing a remote from
Priya,
JP Morgan.
Did you see the view she has?
I know.
She said she's looking at a brick wall on Madison Avenue.
Exactly.
Right now, I'm just looking at the screens, but yes, it's a beautiful building.
The Bloomberg screens, right?
Yes, exactly.
Well, thank you. You can come back. Priya Misra, thank you so much with JP Morgan. And really important discussion here earlier on the Sharpe ratio. If you don't know what that is, look it up, study it. But I just can't say enough about the financial media return. You know what? It's about the risk along the way matters a little bit. That was a clinic with Priya Misra of JP Morgan.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Joining us now, Mike Wilson with Morgan Stanley with his exceptionally intelligent views on the market. He has not been a raging bull. He's been someone who has participated, but done it with a bit of angst and caution as well. There's the Mike Wilson word, Mike Wilson, nimble. If I'm nimble after 5 days down in a row or whatever it is, how nimble am I into Monday? What do I do now to reposition with confidence?
Well, good morning, Tom. Look, I think, and Happy New Year. I think what you said earlier is listening to you chatting about, do I get in now? What do I do? And that's really not ever the right strategy. The right strategy is to have something committed at all times and be, balanced in your portfolio so that you can ride out, turbulent times when they arrive. And look, we've had a little bit of a bad stretch here since the beginning of December, which doesn't really surprise me. Given the run that we had, post-election, there's just a lot of euphoria. So we're having a bit of correction here. I do think the first half of 2025 will probably be a bit more challenging. And then the second half sets up pretty well, assuming that, forecasts around the economy and earnings come through. Everybody knows the market's expensive. Everybody knows that, we've had and sentiment's crazy right now, and that's just part of the game. I mean, you have to deal with that, and that's why you have diversification in your portfolio.
You look at factors. I think of Liz Ann Saunders over at Schwab as well. Which is the factor now with the closest Mike Wilson study?
Well, we look at all of them, obviously, and I would say what's been the factor that's been most in favor has been quality and momentum. And then recently, both of those came off a bit because that's where people were positioned. Okay, that doesn't mean that those aren't still the places to be. It just means that we're having a bit of a pullback in here. And I think going into 2025, there are some areas that got probably a little bit overdone. Some of the growth areas, that factor in particular, probably people are paying up for that too much. I think some of the size factors, people rotated probably a little bit too much into the small cap area, and they're giving some of that back now too. So that's just one sort of arrow in our quiver, and but it's definitely something we watch closely.
Hey, Mike, I'm reading your most recent note about the breadth of the market. It gets me to thinking here. I got the S&P 500 in 2024 is up like 24%, yet the equal weighted S&P up only like 10 or 11%. What does that tell you? I mean, and how concerning is that for you?
Well, I mean, it's not really. Remember, breadth is a symptom, of what's going on, not the cause. Okay. And so the weaker breadth tells us that certain things are going, and this is something we think we've gotten very right over the last several years, which is that it's a very government heavy economy, right? So if you actually look at the private economy has been sort of languishing, whether it's manufacturing or housing, some of the consumer goods areas. I mean, they're actually in a recession. They've been in a recession for 2 years, and the government, heavy-handed form of government, whether it be fiscal or monetary policy, has kind of kept things buoyed. And the market has figured that out. And of course, you have things like AI, maybe weight loss drugs, certain themes that are very specific to certain areas. And those areas have carried the day. Okay. So I think the weak breadth is symptomatic of this very unbalanced economy that we're dealing with. Now, one thing to point out, however, is the second half, really since September, the breadth improved tremendously. And actually the breadth in 2024 was still way better than it was in 2023. So it's not all bad. But it is like I said, it's a symptom of what I think is a very unbalanced kind of recovery that is ongoing.
So I guess as you think about 2025, Mike, I think a lot of folks are saying this really, if there's going to be any performance in 2025, it really has to be driven by earnings growth, because maybe the Fed's going to cut a couple of times, but I'm not sure how much more than that. Are you concerned that the earnings leg of this story is maybe a little ahead of itself?
Well, I mean, look, the markets they get ahead of that, right? So the markets, multiples, rallied because it anticipated an earnings recovery. Of course, this summer we had some turbulence, and then the fall, things picked up again. We think most of the rally in the second half was driven by sort of liquidity factors and, just sentiment picking up around the election, just getting that behind us, a definitive outcome, et cetera. And so now we're a little bit ahead of ourselves. So multiples probably have to consolidate a bit. The key for this year is, are we going to get a broadening out in the earnings participation? Okay, so earnings have been pretty lousy for most companies over the last 2 years for the reasons I mentioned earlier. Okay, interest rates are too high for most businesses. Government is crowding out a lot of smaller businesses and even larger businesses to some extent. The global economy is still kind of stuck in the mud. So a lot of multinationals are not doing well. So the key for next year is, can we see a broadening out of that earnings recovery? We think we can, and that's our job. Our job is to figure out where is that earnings going to pick up. Financials is one area where we've gotten more constructive recently because of the earnings story specifically.
Mike Wilson with us with Morgan Stanley. If I need breadth to go higher, Mike Wilson, is healthcare so dominant that if healthcare doesn't perform, I don't see an intelligent gain in the market?
No, I don't think so, Tom. I mean, healthcare has been languishing for a while. It's been, there's been some big home run winners, and as I mentioned earlier, some of the weight loss drug winners, et cetera. But healthcare has been languishing for the better part of a year and a half on a relative basis, and the market's been fine. So I don't think it's necessary condition. It would be helpful. We'd like to see it happen. I think for healthcare specifically, with the appointment of Bobby Kennedy, well, let's see how that goes. I mean, I think the sector is probably going to remain under pressure until that confirmation hearing.
Interesting.
And then I think from there we might get a bit of a bounce.
Yeah. Mike Wilson, tell me about the necessary condition for breadth to work. What is the single item that you're studying with your team to say we have good breadth?
It's what you said earlier, Tom. We need better breadth of earnings revisions. I mean, this has been a theme of ours for the last 2 years. One of the reasons why we weren't maybe as enthusiastic as others in terms of the rally we've had is because we thought it would be narrow. In fact, our forecast suggested that the earnings recovery itself was driven by heavy cost cutting in the Mag 7. And then, of course, they had AI, which helped a handful of companies. You had a few other themes that were driving growth. You had government support for infrastructure spend, things along those lines. And so it was very narrow. So in order for the market breadth, the price breadth to get better, you need earnings breadth to get better. I don't think it's that complicated. And that's what we think should happen in 2025, assuming, once again, that we don't get some policy changes that are maybe negative for the market in the near term. And that's really our concern in the short term, is that we think some of the policy changes are probably going to be more negative in the beginning and then more positive in the second half.
Hey, Mike, as we all know, the S&P 500 over each of the last 2 years has grown north of 20%. I'm not sure earnings have grown to that extent. What's the valuation call right here as you think about the market here, Mike?
It's expensive. I mean, that's not a great insight. I mean, this is probably the single biggest miss by, I think, everybody in the last 12 months. I don't recall anyone saying they thought we would trade to 23 times earnings, but of course everybody rode the wave, including us, and you're happy to take it. And so now you're sitting here 23 times earnings, and you're like, well, now we need to see the earnings actually surprise to the upside. And you're exactly correct on the fact that earnings have not been the main driver of the returns. The main driver of the returns has been equity valuations.
Right.
And there's been some specific names that have done a great job in earnings, and those are unique. But overall, this has been probably one of the biggest multiple expansions we've ever seen, coming out of a recession.
Okay, so what does that do with cash for Mike Wilson? For Lisa Shallot and Morgan Stanley Wealth Management, is cash your friend right now?
Well, I think, short duration fixed income in general has been our friend for the last several years. Being underweight, duration, whether that's 2 years or 1 year or cash, they're all doing the same thing for your portfolio, Tom. They're giving you a nice 4 to 5% return with very low risk. And so that's a great place to have some of your money. Once again, not all of your money. We're probably 5 to 7% kind of in that cash rate region, which is 2 years and in. And that's fine. That's a good place to be when you're getting compensated. I mean, just recall 2 years ago, you were getting zero on that cash. Now, that's a bad deal. But today, you're getting actually a pretty positive return. And there's a place in every portfolio for something like that. Just ask Warren Buffett.
Hey, Mike, it seems like the market's discounting 2 Fed rate cuts this year. Is the market okay with that? Or do you think the market needs to see a little bit more? Or do you think the market is fairly discounting 2 rate cuts?
Well, first of all, let me just make an opening statement about that. I mean, if there's one thing that the markets have been more wrong about than Fed cuts over the last 4 years, I'd like to know what it is. So, I mean, this has been probably the single biggest whipsaw, both on the upside and the downside, that the markets have gotten wrong. So I think looking at the bond market right now, what they're pricing in is a waste of time because they don't know. The Fed doesn't even know. What I would say, however, one of the reasons why the breadth has deteriorated, I talked about that as a symptom, the cause of the breadth deterioration, one of them is the fact that rates have gone up at the back end almost 100 basis points since the Fed has cut 100 basis points. Think about that. That means the term premium has really gone up sharply. And that's been something we've been focused on. When the term premium kind of gets up into this range, you actually now are at risk of having an equity valuation correction. So we think that's probably the main reason why the breadth has deteriorated here recently, more so than earnings. And I think, 2 cuts, sure, why not? Could we get 0 cuts this year? Possibly. Could we get 4 or 5 cuts? Maybe. It just depends on how things play out. But I think right now, 2 cuts is kind of the best guess. And the bond market is probably a little bit suspicious about that based on how the back end's trading.
Mike Wilson, thank you so much. Chief U.S. Equity Strategist, Morgan Stanley, generous to be with us.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Yes, into 2025, we're extending the Lisa Mateo Hour into a longer day part, as they say in the business. Lisa, what do you have today?
So younger drinkers, this is apparently according to Financial Times,
Perfect.
they are sipping less French wine. Yes, they're opting for different beverages, rosé, beer, spirits, cutting out alcohol altogether. So I'd like to go to Paris correspondent Tom Keene and find out, were they sipping less French wine in Paris?
Yeah, I think they are. It's in the zeitgeist over there. They're very concerned about it. And what's fascinating is selected restaurant owners talking about how people are just flat out drinking less.
Yes.
And,
yes.
you know, I did a shout out on Twitter. John Farrell absolutely nailed the impact of this Ozempic thing. The over last 3 days.
Right.
6%, people are eating 6% less food.
Yeah,
Right.
and it curbs your alcohol.
Yeah, and drinking alcohol has a lot of sugar, so they're trying to stay away from, I mean, you know, especially wine, especially red wine.
Do you want a pro tip?
And that's, yes.
You have a martini, maybe two, and these are smaller martinis. These are Mad Men martinis. And then to cut back on alcohol, the third martini, you have a reverse martini.
What is that?
Which is a little bit of gin, but with vermouth. That's how that's a measured consumption decline.
All right, interesting.
Interesting.
Yeah, but the red wine thing is a big deal.
No, but it is, and
No,
it's causing a lot of people to change. Like a lot of the producers, they have to focus on higher quality wines, right? Because the younger generations like certified organic wines, and then they're offering reds, like whites, low alcohol wines, but also making the low alcohol wine, it's more expensive. So now the producers are having to fork over more money to make these low alcohol wines.
We're drinking Barbarescos now. That's what we're into.
What is it?
We're drinking the Barbaresco, the Nebbiolo grape, coming out of it.
Oh, listen to you.
Got turned on to that a couple years ago, and that's what we're drinking.
Yeah, I was weaned on Morgan David MD 2020. That's where I was next.
What else?
America apparently getting better at getting things done. Workers and companies are getting more productive, okay? This is Labor Department data. Productivity rose 2% in the third quarter compared to a year earlier. But the Wall Street Journal says the reason why a lot of business owners using AI to help write things like marketing plans, emails, social media posts, the influx of immigration. They say immigrants often take those manual intensive jobs, so that allows other workers to move up to these highly skilled roles. But also, you know, the QR codes, that makes things, you know, better because you have instead of paper menus at restaurants. I'm sure you've seen that. And
I hate that.
You do hate it.
I hate
really?
that.
Passion.
Yeah, with a passion. Yep.
Why are you doing this? Sparta's actually listening this morning.
Well,
he
because
only works like 2 days a week.
Exactly.
But Sparta's listening, and you're talking productivity.
Yes, faster productivity. You know, productivity grows, the faster the economy can grow.
So
there
Tucker's
you go.
got to get with it. I mean,
Yes.
the weak
Jump
point
on
here is
board.
John Tucker. Next.
And the head of YouTube, I know you're going to like this one, is saying that artificial intelligence and online influencers are going to help supercharge their growth in the coming years. So this is Neil Mohan. He's telling the Financial Times they're ramping up AI spending. So they have two experimental features from DeepMind. That's like their AI unit. It's called Dream Screen and Dream Track, and they generate videos and music from text. So that's one thing they can do. They also auto dub, which means that they translate to English language videos into 8 other languages. And they're saying it's going to help with online creators because that's their big draw. Hundreds of millions of Gen Z fans are from these online creators. So that's really helping, you know, to get their subscriptions
down there at
growing.
the cafe.
What was that?
Là-bas au café.
That's a productivity.
That's AI.
Productivity.
Là-bas, le café.
Like, where did that
I'm
come
taking
from?
French level -1. Do you have one more
Maybe
for us?
AI, that is. Oh, and since yesterday we were talking about Apple TV Plus,
Please.
this story stood out to me. Apple is actually offering a free all-access pass to Apple TV Plus this weekend,
Ooh,
today through Sunday, so you can test it out, try it out, see if you like it. And any device that supports Apple TV, you have to want to, you know, sign in with your Apple ID, so all those restrictions. But you can try it out for free if you want, and they got to get those subscribers to
Paul,
come
what do you
in.
think of this? I mean, where are we in the streaming wars?
Streaming,
in the
I mean,
first
it's
quarter?
obviously Netflix hugely profitable. Disney finally now profitable, and some of the other players are going to be becoming profitable. So, again, more and more content's going there, Tom. And the biggest issue is live sports. More and more live sports you're finding on the streaming services here, including
like the
NFL.
football games coming up.
Yep.
Penn State, Notre Dame's on ESPN.
Yeah, we're getting some. The wild card games for the NFL are on Amazon Prime. So if you don't have Amazon Prime, you need to talk to somebody in your extended family and figure out if somebody's got a membership there, because that's where you're going to find the NFL
I wonder where the
wild card games. Go figure.
Let's
go on streaming.
I'm hooked on Silo, and there's some disagreement in the household. Some people think it's slow and doesn't move fast enough.
I have to agree with that.
Yeah.
I might agree with that person in your household.
Yeah. It just
But
doesn't
my husband
move
loves
fast
it,
enough.
loves it.
Yeah, and I'm finding it just magisterial.
Landman.
But I think like 12 people watch it, Paul. Apple TV is, they call it dad TV, and I can see why.
Is that right?
Oh,
Okay.
I've
It's not
never heard that.
Netflix.
Okay.
It's not Netflix, you know.
Dad TV.
I don't know.
Well, the talent's getting paid. They're making all these things for Apple TV and Paramount and all the streaming stuff. And the A-list talents, they're getting paid. So, like, I'll do this stuff.
Out on YouTube, live chat, ask Lisa, Costco road trip this week?
No Costco road trip. My paycheck went there last week, and I am done.
Lisa Mateo, thank you so much for the newspapers.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.